Hello, everyone. Hello, hello. Thank you so much for being here. I hope you've just enjoyed that pitch session that we just had, and I hope you've had an amazing, amazing time. My name is Edith Njagi, and I am a co-founder here at Arielle for Africa, and it has been an absolute honor serving here as chief steward, and just leading the team and learning from the team. I will be highlighting our key achievements over the last 5 years, and what we've been able to do, right? The impact, tangible impact that we've been able to have. So, in the last 5 years, 37 businesses have received funding in different sizes. This has ranged everywhere from $5,000 tickets to $150,000 tickets. We've had 32 unique programs that have been run. These have been online, in person, hybrid, where we have also traveled to co host programs as well. But we've been able to do 32 of them in the last 5 years. We have coached 53 companies. One on one coaching is something we're very passionate about, and making sure that especially business owners feel heard, supported, encouraged, and just like they're not alone. So coaching, business coaching, executive coaching is something we're very, very passionate about as well. In this time, we've also grown to 13 African countries, moving into 16 this quarter. We have trained financial literacy programs in collaboration with the and university players in 3 African countries, and this has gone to 879 people. We have led to the creation of 1,906 businesses. These are entrepreneurs who came on here and hadn't set up a business formally and ended up leaving having set up a business as a result of our programming. Our current country footprint: South Africa, Rwanda, Ghana, Ethiopia, Libya, Somalia, Nigeria, Egypt, Kenya, Zambia, Uganda, Zimbabwe, Tanzania, Diaspora Africa, Senegal, Cote d'Ivoire. All of these are countries where we have supported entrepreneurs. The industries that we have worked with: cosmetics, professional services, agriculture, healthcare, tech-driven businesses, retail, mobility and transport, food and beverage. We have also managed to secure 37 partners across 5 continents, and we love, appreciate, and celebrate each one of our partners over the years. Today, we are celebrating 5,643 entrepreneurs joining the Arielle database directly and through our ecosystem partners and players. I am so grateful and so thankful, because this really is a testament to the growth that can happen when we come together, the growth that can happen when we collaborate, the growth that can happen when we realize that we are stronger and better together. On that note, I want to break down investment options, because as Ferouz shared at the beginning, the key focus of this showcase is to make sure that entrepreneurs are able to understand investment better, understand how to interact with investors, and understand how to have those key conversations. When looking at your current investment options, and again, I'll speak from what we are seeing on the African continent at the moment, we're seeing a time where prior to COVID, and even just leading into COVID, we had a lot of finances being thrown into the African continent. A lot of investors were very interested in pumping money into African businesses. However, private equity has dropped since then by close to 60% over that. And what this is telling us is that a lot of investments suffered during the COVID period. So we're at a moment in time where we had capital coming in, and now we are having capital slowing down and portfolios slowing down, but they're still very much there. So when you're looking as a business at receiving investment, you essentially have, I'll call it 3 options. The first one is bootstrapping, right? Which I always advise initial years, just because you don't want to lose too much equity until you understand your worth and until you understand your market. A lot of evolution happens for businesses in the first 5 years. So take your time. It's okay. You can bootstrap. Meaning what? Meaning you're sitting and figuring out your business, you're building traction, you're building partnerships, building relationships, figuring out the industry. Then you can get into a space where you have the two key pipelines, okay? And this is based on our experience, what we've seen work very well. Number one is the debt pipeline. So the debt pipeline, which I'm going to now break down, you have either project financing or business financing. Project financing is you're an established business, but you're setting up a new project. Business financing is you're raising debt business to maybe act as growth capital or take things to the next level, what have you. So when you're looking at these two categories, when you're looking at, say, project financing and business financing, the requirements, how you handle your due diligence, the sort of investors that you approach, completely different, but not always. And I'll explain why. When you're looking at, say, project financing, where, I don't know, you have a tender, right? Or you have a contract that you need to deliver on. So you maybe are in agriculture and you have an order. I don't know, you need to do, I don't know, tons and tons of coffee. And you need to ship this, right? To export. You can access what's called trade financing. And trade financing, currently what we're in collaboration for you to access, or for entrepreneurs to access, is anywhere between $300,000 to $150 million, $200 million, depending on what's going on with the business. A lot of times, trade financing is based on historicals, meaning your relationship with your bank will determine whether or not you can access this trade financing that I'm talking about. Period, 30 days, and you'll likely have the financing. But now when you're on this other side, right, we're still within project financing, but you're not going for trade, because trade financing is you need money for a contract, but you're going to get the money to pay it back within 3 months, 90 days, maybe 1 year. Everything is paid back. But when you need longer term financing, right? So longer term business financing or project financing, you're looking at a space where you need a different type of debt. Now here, senior debt is an option. Senior debt will likely be at an interest rate, likely for a period, anything from, honestly, seen 3 years all the way to 10 years, even more than that if possible, but that's rare. Then you have what we call mezzanine. Mezzanine sits on your balance sheet almost as equity. It has like equity characteristics, but it's more of a debt instrument. I'm hoping no one is bored at this moment, but it's more of a debt instrument. And this one essentially comes into play where within 6 years, you have 6 years, maybe sometimes 4 years, maybe sometimes 8 years, but you essentially receive mezzanine from an investor, and then you pay it back with a premium, right, at the end of the period. So it's debt, yes, but it has like equity characteristics. The next thing after this is preferred equity. So this is where you have an investor that wants to cash out first in case of any issues. So yes, it's debt, but it also has that equity characteristics. They also get, there's that preferential treatment, right? So in case anything happens, they're the first to collateralize or cash out. When we look at pure equity, which is what a lot of startups are looking at, they're looking at getting pure equity. Here you have three categories. Private equity that you can go to, you have venture capital that you can go to, and you have angel investment. So here I'm not dividing it based on what the instrument looks like. I'm dividing it based on the investor, because with each of these three different groups, the characteristics are very different. When you're looking at an angel investor, likely they're putting in money because they can see a lot of potential. They look at the business, it's there, the future of it is there. It's likely very young, so they're coming in very early. This will likely be pre-seed, maybe seed stage investment, which is in your first round. So they're coming in very early. And a lot of times it has more to do with the founder than the business, because the business is not there yet, right? The angel will be there to support you as you build the business, but you actually, as the founder, are the business at this point. Then over time, you can now get into what we call venture capital. Venture capital is a bit more, okay, they're looking for 10x returns. They're looking at, what's your MRR? That's your monthly recurring revenue. What's the IRR? The returns that they would be getting. And then now after that, we now look at the next stage, which is your private equity, which is a lot more large scale. Typically, go to them when you're Series A, B, C, mostly B, C. I would suggest. But again, this is just from what I'm seeing. Now, in terms of on the continent, we're seeing that a lot of entrepreneurs need $10,000, $50,000. Typically small tickets, right? Which is understandable. And when you're looking at this, I would say go angel investor pipeline. But if you're at the place where you've already raised something, you're already beginning to see your revenue, then you should be looking at, maybe going through other alternatives. If your cash flows are good and you don't want to lose equity, then look at your debt alternatives. But like I said, bootstrap, that's always your first stop at the station. When you're getting into the investment due diligence, right? This will vary with each investor type. But I would say let me backtrack. When you're approaching an investor that could be interested in your business, understand, number one, the numbers have to make sense. Number two, it has a lot to do with who you are, your background, and your abilities as a founder or as a team of founders. Your team is your everything, right? So that's also your value proposition. Your market has to make sense. It needs to be sustainable. It needs to be scalable, and the numbers need to add up. I sit a lot on the numbers because I see that's where most founders are failing. But once you have confirmed interest and once you have some form of engagement, some terms like light terms that have been shared, then you're jumping into what we call the due diligence phase. Now, due diligence can be pretty short or pretty long, depending on the type of investment you're trying to qualify for. But here, you need to have your ducks in a row. As a founder, don't rush this. Don't rush this process. Don't rush your documentation. Don't rush qualifying for this financing. I would rather you take your time, but you do it right. Here, key things that you need to have. We have a due diligence checklist that's available. You can email support at Arielle for Africa, and that will be shared with you.com. And that will be shared with you on essentially all the documentation that you need, from your tech stack to contracts to commercials to KYC, all these things that can be shared with you. But here, the key thing that I see a lot of founders failing at is they don't do their business valuation. So you need to know the value of your business. And this is how you can then determine what percentage equity is taken, especially if you're going the equity route. Do business valuation. Do it best case, base case, worst case scenario. Do it with projections, right? Financial projections. Make sure I always advise DCF, right? Or venture capital method. But again, take your time, right? With this. The other thing I'm going to say is that when raising money, not all money is good money. Money is good, but not all money is good money. So make sure that you find the investor that works for you, you find the terms that work with you, you find something that you can live with. If you can't fall asleep at night and sound asleep, okay? If you're having heart palpitations, entrepreneurship does that. But if you're having heart palpitations, then it's likely not the investor for you, right? So just make sure that, again, this is an investor that you're comfortable with, that you align in terms of where the business is going, what it's about. You align in terms of the directions to take, the approaches, that you're aware, right, in terms of board seats and what that means, especially if you're allocating that and voting rights, right? These are all things that I really emphasize a lot because they're important and they can make or break the business down the line. So you need to be clear in terms of everything that you are prioritizing, right? Good money and bad money has nothing to do with the money itself. It has more to do with the terms. So make sure it's terms that you're willing to live with, terms that you can survive with in the long haul. I always suggest find support, find advisory, find somebody that you can talk to, find somebody that knows what's going on. We have handled cases or tried to even handle and salvage cases where entrepreneurs are selling their ideas, 50% of their business, 60%, even 80%, crazy things, for peanuts, right? Or even giving it away to family, for I don't know, $10,000, $20,000. And the reality is right now, it might sound good, but down the line, when you need another investor to come on board and you have nothing to give them because you already lost your business, then it's a different conversation. Or where you get to a point where you no longer have a say. It's your idea, it's your business, you're the one who started it, but you're not the owner anymore. Your voice means nothing, right? Because you've been diluted all the way to 30, 20%. So these are all things to remember, guys. But again, in case of any questions, in case you need further conversation, reach out to us at support@arielleforafrica.com. And we are more than happy to advise and give you more feedback on this investment options and alternatives journey. But I hope that this was a supportive one. Till next time, ciao.